So what are some of the typical things that we're seeing lenders do in this market in terms of trying to actually work out a deal with the borrower?
Well, I mentally break these things down into three categories. There's the economic terms of the debt itself, interest and principal payments and whatnot. And then I think about the credit support behind the debt, the collateral, and whether the borrower could offer up any guarantees, things like that. And then I also think about the lender's legal remedies, what I call the legal process. Right? Those are the sort of three baskets that you might address in terms of in a workout. In terms of the economic aspects of it, of course, there could be a principal reduction in the amount of the debt that the lender could offer the borrower, or they can change the interest rate, drop the interest rate, or have an interest rate that accrues at a certain rate, but only a certain amount is paid each year. You can defer principal payments, and sometimes in exchange for some current relief, the borrower will give the lender some sort of equity kicker based on some metric at some later time in the cycle, or the lender may convert a portion of the debt into the equity of the borrower, or any combination of these things. And in exchange for current relief, the borrower might be called upon by the lender to either put up more collateral behind the loan, or put up what we call the dreaded guarantee, personal guarantee, to stand behind it. And also, the lender will often look for some revisions to their remedies in the event of a foreclosure, so that perhaps they can have an expedited acquisition title to the property if there's a default down the road.
So Dan, let's take the simplest sort of example where the lender just agrees to an outright reduction of the principal balance of the loan. What's the tax implications of a transaction like that?
Well, it's kind of simple. A straight debt reduction that is agreed to by a lender is going to result in cancellation of indebtedness income, or COD income as we call it in the trade. And, COD income is taxed at the rates of ordinary income, which in 2010 federally is 35%, soon to be 39.6% in 2011. And if the borrower is a New York City resident, for example, the aggregate state and city rates can reach as high as 13%.
So let's take an example for a second. Let's say we had a borrower who acquires a building for $200 and was able to borrow 90%, which is $180, and now the value of the property has dropped to $100, and the lender comes along and says, okay, I am willing to drop the amount of the debt that you owe to 80, which is 80% of the fair market value of the debt. The borrower in that case is looking at income of 100 and a tax of 42 or 43 on that 100, and no cash to pay the tax. Pretty bad result.
That's the dreaded phantom income, it's known as, right? What also could happen is, in the situation you just described, often the lender will say, okay, let's split the debt into two notes, right? We'll do an A note, which has the reduced principal amount that you described, and an interest rate, so that based upon the current cash flow of the property, it can be serviced. And then the rest of the debt we'll put in a B note, and it'll mature at the same time, but if you perform under the A note, right, the B note will be forgiven and go away. So the principal and interest on the B note are contingent. Those are going to be ignored, and there'll be COD income for tax purposes also.
So pretty difficult result to have a lot of income and basically no cash to pay it. That's going to be really difficult for a lot of people to pull off.
Absolutely.